Good morning, everyone, and thank you for joining us for this timely Water Tower Research video podcast. Over the past week, global energy markets have experienced significant volatility as escalating conflict in the Middle East has disrupted supply chains and pushed crude prices above the $100 per barrel level at points. Shipping through the Strait of Hormuz, normally responsible for roughly one-fifth of global oil flows, has been disrupted, while several regional producers begun reducing output. These developments are already rippling through the global economy, with gasoline prices in the U.S. rising sharply and governments considering potential strategic reserve releases to stabilize markets. Today, we brought together members of our natural resources and energy team to include Jeff Robertson, Richard Tullis, and Chris Degner, with many decades, I can't emphasize enough, many decades of combined experience to break down what is happening, what it means for investors, and what to watch for next. So to start things out, I'd like to zoom out and talk about the geopolitical backdrop. We're seeing production cuts from several Middle East producers and disruptions to shipping routes. From your perspectives, how meaningfully are these supply disruptions relative to oil markets? And more importantly, is the market currently pricing in a short-term shock or the possibility of a more prolonged disruption, in your opinion? Jeff, I'll let you kick things off.
I think I'd start by the notion that this situation is extraordinarily fluid from hour to hour and day to day, depending on what's happening in the skies and on the ground, in Iran in particular, and also any kind of damage or disruptions to oil producing and or loading facilities in the Persian Gulf region. I think what we've seen so far out of the producing countries is a lot of caution. Cutting back production, storage has been filling. So as a result, there's limited places to put the oil if it's not transiting out of the Gulf and into global markets, in particular into Asian markets where a lot of the crude ultimately flows. So I think what we've seen so far is a lot of caution with respect to what happens from a military standpoint, protecting infrastructure to the best that the producing countries can, and see how this plays out over the next, hopefully, days and weeks as to what the duration of any kind of situation is. I think right now, with the shape of the forward curve for Brent, with the high anywhere from or north of 90 over the weekend, it was above $100 a barrel, to changing hourly. That right now the market seems to be pricing in something with a shorter duration. And the reason I say that is because the forward curve in 2027 is back down in, I believe, the mid 60s as of today. So we have a spike. The length of that spike ultimately gets dictated by the situation on the ground and whether or not there's any lasting disruption to oil production capacity and or just the ability to move oil and secondarily natural gas out of the Persian Gulf.
Thanks for that, Jeff. And gentlemen, as we go along, if any of you have an individual opinion, please just feel free to opine as we go along.
Yeah, I might just I'll
yes,
just
please.
quickly add to Jeff's comments there. I think yesterday's, really severe reaction when the markets opened up and yesterday evening in the US, the oil markets, and then continuing overnight. I think you originally saw that spike probably related more toward worries about damage in the Middle East to facilities. You had the reports of Israeli strikes on some Iraqi fuel supply centers, and then news of cutbacks in Iraq on the tune of about 1.5 million barrels a day, and Kuwait as well, and then UAE and even Saudi Arabia starting to talk a little bit about it. So I think you saw the spike there, and then today's, I guess since noontime today or so, things have calmed down considerably. You had President Trump talking about maybe a shorter duration war, the 300 to 400 million barrels of potential releases from strategic reserves. That's only a couple of days of global production, represents a couple of days of global production, maybe like 15 to 20 of what would normally flow through the strait.
You mentioned Strait of Hormuz. If it remains constrained, I should say, for an extended period, what percentage of global supply could realistically be impacted?
I can jump in there. There's some alternative routes out of the Persian Gulf. There's a pipeline that runs to the east side of Abu Dhabi to a port called Fujairah that has capacity of around 1 to 1.5 million barrels a day. Saudi Arabia has a pipeline that runs from the west to the east that they can reverse and send oil out through the Red Sea. It's got capacity of about 4 million barrels. In Iraq, there's a couple smaller pipelines that they can run north into Turkey that are another 500,000 barrels. So there's call it like 6 million barrels of oil capacity that they could take out of the region outside of the Strait of Hormuz. And the region currently exports about 15 to 20 million barrels of oil. So roughly a third of it can go other ways.
Okay, that's really helpful. So if we move over to the supply side more broadly, in a scenario where the Middle East output remains constrained, which producers globally have the greatest potential ability to offset those barrels in the near term? And kind of as a follow-on, how do you think OPEC approaches the situation? Do they attempt to stabilize the market, or does the current price environment benefit them?
I would say OPEC always wants to stabilize the market.
Yeah.
Their ability, but part of their ability requires them being able to get oil to the market. Going back to the earlier comments around shipping and moving oil out of the Persian Gulf, I think the Strait of Hormuz represents about 20% of global supply, and the ability to get oil into the market to help stabilize it is dependent on being able to move oil out. That takes into account a lot of different issues ranging from just simple insurance rates on tankers to some of the issues that we've talked about already with respect to production curtailments, full storage, all of which feeds on itself and ultimately could take some time to unwind. So I think the OPEC producers' goal is for stability. That seems to be what their goal with their minimum production capacity objectives is to maintain enough capacity that they can help supply the market to keep oil prices within a band that where consumers and producers can live relatively comfortably.
Great. And specifically for U.S. shale producers, bringing it back home for a moment, how quickly could production respond if oil prices stay elevated to these levels?
I think it depends on their capital priorities. I mean, the most of the U.S. producers, include majors like Exxon, for the last 6 or 8 or 10 years, have emphasized returning cash to shareholders over sheer production growth. So I think with uncertainty around the duration of elevated price levels, that's going to be the guide of their capital spending. I don't think they're not going to react to a price spike that's been in existence for 8 or 9 days now, because these pads that they're developing can take 10 to 12 months to bring on production. So I think they'll sit with their capital budgets the way they formed them heading into 2026, which is probably on a WTI or Brent price deck in the 60s, and see how this unfolds before they make any adjustments.
Yeah, I totally agree with that comment. All of us have worked in the oil patch or as analysts for many years, and we know that the energy companies, particularly the U.S.-based companies, just did not get rewarded for production growth 5 to 10 years ago, and really they've learned that lesson, and I think they are going to show some capital discipline here.
It would be functionally if they decided to go for it, and let's say oil prices were $80 a barrel for 3 months, and they had some confidence in the price. It'd probably take 12 months to bring supply on, I think, between going out and locating rigs and adding crews and getting it hooked up into pipelines. So they can do it. It's just I think they'll need confidence in the price signal.
That all makes sense. So if I kind of pivot the conversation a bit and get back to strategic reserves and government policy, governments around the globe have been discussing potential coordinated releases from strategic petroleum reserves. Historically, how effective have these releases been in stabilizing markets? And in the current environment, would releasing reserves address the underlying issue of the bottleneck in transportation and shipping routes?
It could. I mean, going into the Russia-Ukraine war, they released about 250 million barrels over the course of that exercise. So, Jeff, sorry to interrupt you, but
I was going to say, take the U.S. for example. I think to Chris's point, at the beginning of the Ukraine war, The U.S. had nearly 640 million barrels in the SPR.
Mhm.
Last week, the U.S. had 415 million barrels in the
Yeah.
SPR. So we're over 200 million barrels lower than we were at the beginning of the Ukraine war during the early part of the Biden administration. You can argue how much of a policy response that was toward oil, potential oil sanctions on Russia versus just trying to lower the price of oil. If the goal is to lower the price of oil, you could argue whether or not it had mixed results. What increases the price of oil or what decreases the price of oil long term is having more oil in the system. So we could have that with a more stable Venezuela situation, depending on the outcome of what happens in Iran. Ultimately, that could increase the amount of oil available in the system, which would probably argue for softer prices rather than higher prices. But
I
particularly
think what's
so.
on,
I
Go
would
ahead.
put the caveat that all takes a lot of time.
Right.
I would add that what's kind of unknown is how much storage China actually has. So as the US reduced its storage from roughly 650 to 415, as Jeff mentioned, at the same time, China continued building onshore storage of oil. So globally, like while it looks like the US may have declined its absorbers for a supply shock, arguably China has increased it quite a bit. So I think some of the use of those strategic reserves are also to match the quality type of oil with the type of refineries that use it. So a lot of the Gulf Coast uses heavy and sour oil. We don't need to release that necessarily from the reserves, but other lighter and higher quality oils, we might need to do that. So
And it's probably worth mentioning at this point too that we entered 2026 with thoughts that the market would be oversupplied by 2 to 3 million barrels a day. So you still had that overhang as well, and that was what was pressuring prices, as Jeff mentioned earlier. So that capacity could still be there, and probably OPEC may have had excess capacity of 1.5 million barrels, say, overall. Not necessarily always the grade that you want, but still had that spare capacity.
Understood. So now let's bring it around to the U.S. consumer. To state the obvious, gasoline prices have jumped significantly over the past week. Can you walk us through why retail fuel prices move so quickly when crude spikes, which is kind of self-explanatory? Discuss how much of what consumers are seeing is driven by crude prices versus refining margins and product markets, please.
Richard, you want to take that?
Yeah, I would say, the initial reaction here over the past, what people are seeing at the pump now compared to, say, when they last visited their particular gas station 7, 10 days ago, 2 weeks ago, is related to the price spike and retailers, taking advantage of that. It hasn't necessarily flown all the way through to their cost structure yet, but it's on the way. The RBOB, I believe, is up about 70 to 80 cents, 75 to 80 cents over the past 10 days. So some of that's made its way to the pump, and there's probably more to come unless it's backed off some more this afternoon.
I think one thing to keep in mind is that may reflect the rise in gas prices might reflect what the retailers or distributors think the next tank of gasoline will
Right.
cost, and not the one
Yes.
that's currently in the ground.
right.
So
Yes.
with prices spiking, the anticipation would be that the next round that they bring out to the retail system will cost more, and that's probably reflected in today's price. I think we've seen in times past, maybe not necessarily war related, but in times of hurricanes, which is maybe one way to think about this, that when
Sure.
there's expectation that there's going to be a supply disruption, prices spike.
Right.
When you realize what that disruption might be, then you figure out whether or not prices stay elevated or if they come back down.
That analogy works really, really well. Another interesting signal we're seeing is the move deeper into backwardation in the oil futures curve. For investors who may not follow commodity structure closely, what does this tell us about the balance between supply and demand in the near term? And what signals are traders watching right now to determine whether prices will continue moving higher or roll over a bit?
I can start briefly. I think what it tells you is that people are uncertain of the duration of a supply issue. That's why the forward curve is so high relative to the curve in the middle part of 2027. It doesn't really give producers a very optimal ability to our earlier discussion to hedge longer term oil barrels at a price higher than what they would have received or might have been, maybe what they had included in their budgeting, and that will, I think, impact their capital decisions. But I think it just reflects the uncertainty as far as the steep backwardation with the forward months considerably lower than the front months.
Okay.
Also reflects that supply oversupply overhang that we entered the year with, that that ability is still there. Say if the Strait of Hormuz started to flow in a pretty regular fashion, things could even out relatively quickly if there's not a whole lot of shut-ins that require a good bit of time to get back online, and then add in the overhang to begin with, and you can get into a oversupplied situation. Not saying that's going to happen, but if it did, you can get it back into it rather quickly.
So the next area I want to delve into is one that actually is keeping me awake right now. Let's talk about the broader economic implications. So oil above $100 historically has had ripple effects across inflation, consumer spending, and central bank policy. In your view, how significant could the macro impact be if prices remain elevated for several months?
Oil, or as we've seen in recent years, oil touches every part of the economy, whether it's the price consumer pays for gasoline for their car, or gets embedded into the cost of getting products from the coast into the stores. It all goes into affect inflation, and I think the uncertainty around how long this lasts has a lot of people wondering what the range of an inflationary impact could be, and also the duration of that impact.
There's a pretty strong correlation between oil price increases in this instance and producer price increases, or a producer price inflation.
Sure.
So the producers aren't always able to pass on all the costs to consumers, but the producers do feel it pretty substantially. I think that correlation's like 0.7 or so.
Okay.
You could argue
then-
it's been
Okay.
disinflationary, Oil, you could argue that oil has been disinflationary over the past few years, given how low it's been relative to historical trends. And so I think it could be a major problem. It could give the Fed a real hard time trying to decide if they should lower rates too. So
next, I want to think as an investor would be thinking right now. So in this type of environment, are we seeing greater upside for exploration and production companies, oil field services, refiners, or LNG exporters? And more broadly, do you think energy equities are currently pricing in a temporary geopolitical spike or something much more structural in nature?
I think in general for the exploration and production sector, again, it's duration. How long does this last? And at what point do companies change their capital spending decisions and capital allocation decisions to adapt to a different commodity price environment than what they envisioned 2 or 3 months ago? I think probably that if we think it's of a short-term oil price impact, the benefit would go, or maybe the potential benefit would be for companies who are trying to delever their balance sheets to where they've got more cash flow in the near term than they might have anticipated, which allows them to reduce debt at a quicker level than what obviously they could do at a $65 per barrel type of price.
Makes
I think
sense.
oil field services, it depends on activity levels. The rig count, at least in the U.S., the rig count in the Permian Basin has declined pretty dramatically, in part because companies are drilling more complex wells, which require fewer actual drilling rigs to tap the same feet of reservoir. Doesn't really show up in the rig count in terms of working rigs, but the complexity of wells shows up in other services that oil field services providers work for the industry.
Mhm. So to wrap things up, guys, I'd like to ask each of you a closing question, and you each answer it individually. So over the next 30 days, what's the single most important indicator or development investors should be watching in energy markets?
Go first on that one. Putting aside Strait of Hormuz, I think we're all in agreement there. But I think any sort of energy infrastructure damage in the Middle East could have lasting impacts because it could take months to more than a year to repair some of this infrastructure, and that has significant impact. That would be what I would look for.
I think one issue that is worth considering, and I don't think there's an answer today, is how, to Richard's point, how any kind of prolonged disruption in oil flows out of the Middle East affects other global economies. A lot of oil from the Mid East, a lot of LNG from the Mid East goes to Asia. And if they don't have access to oil from these markets, they're going to have to find oil and natural gas somewhere else. And so you could see, depending on, again, back to duration, there'll be a little bit of a reordering in trade flows, which there are probably winners and losers in all of that.
Right. Chris?
Yeah, I agree with both of them, and especially on the infrastructure part of it. And I'd watch carefully the big facilities in the Middle East and what amount of damage they suffered through the war. For now, it seems like it's only surface level and things that can be repaired pretty quickly. But roughly a quarter of the world's liquefied natural gas goes through the Straits of Hormuz, and there's no other way to do it. And so if that gets materially impacted, countries will look for other sources of energy. Maybe it's coal or other LNG sources. So that's what I watch for. Thank you.
Thank you. So thank you to the WTR Energy team for the insights today on this video podcast, and thanks to our very large audience of institutional and retail investors that joined us. As always, Water Tower Research will continue providing open access research and investor engagement across the energy sector. Please feel free to reach out to our team with any follow-up questions. We appreciate your time, and we look forward to speaking with you again soon.